In this video, we cover lease liabilities, a highly controversial area of accounting in which some significant changes are on the horizon. Later in the video, we take a look at the financial statements of Home Depot and Lowe's, two giant retailers who lease a very large percent of their facilities. Let's begin by describing how leases work. In a standard lease or rental arrangement, it all starts with a person or entity called the lessor, who owns a facility and transfers the use of that facility to a person or entity called a lessee. The lessee signs a contract that covers a specific period of time, requiring the lessee to make normally monthly rental payments. In a pure rental arrangement, the lessor retains the benefits and responsibilities of ownership, like maintenance, insurance, and taxes. The contractual lease period is much less than the useful life of the facility, and the contractual lease payments are much less than what would be necessary to buy the facility. In these cases, the owner, lessor, reports the facility on its balance sheet and depreciates it, booking depreciation expense on its income statement, while the lessee only books a rent expense each time a lease payment is made on its income statement. This method of accounting for lease contracts, where the lessee simply books rent expense periodically, is called operating lease accounting. And as you can see, it's fairly simple for the lessee. No need to book an asset, no need to book any depreciation, no need to book a liability. Only rent expense is recorded each time the lease or rent payment is made. However, the accounting issues become less simple when the contractual lease period is so long it approaches the useful life of the facility, and/or the present value of the lease payments begin to approximate the fair market value of the facility. Present value concepts are covered in video 45 of this series. And/or the lessee pays the costs normally associated with ownership, like maintenance, insurance, and taxes. These situations are very common for the big box retailers, like Walmart, Target, Home Depot, and Lowe's, and the airlines, like Delta and Southwest, who lease their aircraft with long-term lease contracts, as well as other companies. In these cases, it begins to appear as though the lessee is actually the owner of the facility instead of the lessor, which from an accounting standpoint means that the lessee should treat the facility as a balance sheet asset subject to depreciation, and recognize the contractual lease payments as a balance sheet liability. So how should we account for situations like this? Well, the easiest way is to view the lessee, who is in effect the owner, as if it borrowed money and then used the money to buy the facility. The borrowing would create a note payable and cash to buy the facility. The note payable would be paid back to the lender over the life of the lease with interest. And using the borrowed cash to buy the facility would create a balance sheet asset that would be depreciated over its useful life. This accounting treatment, where the lessee books both an asset and a liability, is called capital lease accounting, or we say that the lessee is capitalizing the lease payments. Current accounting guidelines, both US GAAP and IFRS, require capital lease accounting by the lessee if the lease contract indicates that ownership has transferred from the lessor to the lessee. If ownership has not transferred from the lessor to the lessee, operating lease accounting is acceptable. US GAAP provides strict criteria that, if any one of which are met, require capital lease accounting, and these criteria have to do with whether it appears in the lease contract that ownership has transferred from the lessor to the lessee. Can the lessee purchase the property after the lease for a significantly reduced price, a bargain purchase option? Is the term of the lease greater than 75% of the useful life of the property? Is the present value of the lease payments greater than 90% of the fair market value of the property? If any one of these criteria is met, capital lease accounting is required. The IFRS rules, on the other hand, are much less precise, listing no criteria, essentially leaving it up to judgment. Under IFRS, management and perhaps the auditor together have to judgmentally determine whether the lease contract indicates that ownership is transferred from the lessor to the lessee. If under either system, US GAAP or IFRS, it is determined that ownership has not transferred, the lease is accounted for as an operating lease. The lessee makes no entry at the inception or beginning of the lease, and then books lease or rent expense as the lease payments are made throughout the life of the lease. Very simple accounting. If under either system, US GAAP or IFRS, it is determined that ownership has transferred to the lessee, the lease is accounted for as a capital lease. Here, at the inception of the lease, the lessee books a long-term asset and a long-term liability for an amount equal to either the fair market value of the property or the present value of the future contractual lease payments, whichever is easier to determine. And then throughout the life of the lease, as the lease payments are made, cash is reduced, interest expense is recognized using the effective interest method, effective interest rate times the book value of the liability, see video 41, and the liability is gradually reduced. Separately, the leased asset is depreciated over its useful life using whatever depreciation method is appropriate for the lessee. Let's now move to an illustration of capital lease accounting. Similar to bonds, as we discussed in video 41, the effective interest method is used to account for capital lease liabilities. It states that interest expense on the lease liability is computed each year by multiplying the effective interest rate on the liability times the balance sheet value of the liability or note payable as of the beginning of the period. Now to the illustration. Assume that we enter into a lease contract where we rent a building with a fair market value of $7,572 and sign a note requiring a $4,246 lease payment at the end of each year for 2 years, which happens to equal the life of the building. This 2-year life is unrealistically short, but will work for purposes of the illustration. Here are the contractual cash flows. The lessee obtains use of a building worth $7,572 at time 0, and the annual payments are $4,246 at the end of each year for 2 years. The first question that must be answered is, what is the effective interest rate on this contractual note? Because we will be using the effective interest rate to determine the annual interest expense on the lease liability. If we view the contract as an ordinary annuity cash flow for 2 years and set the present value of that annuity equal to $7,572, the fair market value of the building, we can find the effective interest rate by rearranging the equation, finding the value of the table factor, 1.78, and then finding the rate R that corresponds to n equals 2 years on the ordinary annuity table. This process, calculating an internal rate of return, is covered in video 45. The result is an effective interest rate of 8%. Similar to how we illustrated accounting for bond liabilities in video 41, we will keep track of the journal entries recorded throughout the life of the lease, as well as the value of the note payable at the end of each year on both the balance sheet and the note payable general ledger T account. At the inception of the lease, the lessee records the building at its fair market value, $7,572, and in the same entry recognizes an equal liability, $7,572. This entry places $7,572 in the note payable general ledger account and also on the balance sheet. As is true under the effective interest method, the $7,572 amount not only represents the fair market value of the building, but it also represents the present value of the future cash flows discounted at the 8% effective interest rate. At the end of the first year, when the $4,246 cash payment is made, the cash account is reduced and interest expense is recorded at $606, the 8% effective rate multiplied times $7,572 balance sheet amount at the beginning of the year. And the remaining amount serves to reduce the principal on the outstanding loan, in this case by $3,640 down to $3,932. This amount, which appears on the balance sheet at the end of year, is again the present value of the future lease cash payments, discounted at the 8% effective interest rate. At the close of year 2, when the final $4,246 cash lease payment is made, the cash account is again reduced by $4,246. The interest expense for the year 2 is again calculated by multiplying the beginning balance of the liability times the 8% effective interest rate, but the interest expense in year 2 is only $314, which is much lower than for year 1, $606. This is because the note payable balance at the beginning of year 2, $3,932, is much lower than the note payable balance at the beginning of year 1, $7,572. The entry to record the final lease payment also closes to zero the note payable account. Finally, although not illustrated here, keep in mind that the cost of the building on the balance sheet of the lessee will be depreciated over its useful life. Video 39 covers depreciation of long-lived assets. Let's now take a look at how Home Depot accounts for its leases. Home Depot is the worldwide leader in the home improvement industry, and you may be aware of the extremely large Home Depot stores located across the United States, many of which are leased. Here is Form 10-K, filed with the Securities and Exchange Commission for the year ended January 31, 2016. The income statement shows selling, general, and administrative expenses, SG&A, and depreciation and amortization expense of around $16 billion and $1.6 billion respectively for 2016, 2015, and 2014. The SG&A number includes a hefty rental expense for operating leases. The footnote tells us $868 million for 2016. And the depreciation amount includes depreciation on buildings accounted for as capital leases. The asset side of Home Depot's balance sheet includes property, plant, and equipment that represents a big chunk, over half, 52% of its total assets. And included in this account are facilities accounted for as capital lease assets. If we look at footnote 5, entitled Property and Leases, we see that it provides the detail that makes up the $22.191 billion net property, plant, and equipment dollar amount on the 2016 balance sheet. We also see the capital lease assets, a little over $1 billion, make up only 2.6% of the total property and equipment account, which seems like a pretty small number given the large number of Home Depot leased facilities. Later we discuss why this is such a small number. Footnote 5 goes on to tell us that Home Depot leases many of its retail locations and that most are considered operating leases, while some are accounted for as capital leases. Recall that operating leases are not listed on the balance sheet. The liability side of Home Depot's balance sheet includes long-term debt, which is almost 50% of total assets, and it includes the liabilities associated with leases treated as capital leases. Looking back at Home Depot's long-term debt footnote 3, we see that capital lease liabilities, $763 million, comprise only about 3.6% of the company's total debt. Again, a relatively small number given how many of Home Depot's stores are leased. Footnote 5 also provides a large amount of what we will find to be very useful information about both the capital leases and the operating leases. Financial reporting standards require that companies must disclose their future contractual lease payments for both capital and operating leases. Here you can see what Home Depot expects to pay on its leases during 2016 through 2020, followed by a single dollar amount covering 2020 to 2097. Yes, spanning a 77-year period. And these dollar amounts are provided for both its capital leases and its operating leases. One interesting question is, why are expected lease payments much higher for operating leases than for capital leases? Total future payments for operating leases are $7.4 billion, while total payments for capital leases are slightly under $1.5 billion. It appears then that over 83% of Home Depot's leases are accounted for as operating leases. One important reason relates to how the two accounting methods affect key financial ratios used by investors to assess Home Depot's financial condition and performance. Recall that at the inception of the lease, capital lease accounting places a big asset and a big liability on the balance sheet, while operating lease accounting places nothing on the balance sheet. Now think for a moment about how this difference affects the financial statements, specifically two very important ratios: return on assets, net income divided by total assets, and capital structure leverage, total assets divided by shareholders' equity. As described in videos 29 and 30, these two ratios, when multiplied times each other, equal return on equity, ROE. With respect to ROA, return on assets, the capital lease entry increases total assets, the denominator, thus reducing ROA. With respect to capital structure leverage, CSL, capital lease accounting again increases total assets, which in turn increases this ratio. The reduction in the company's ROA makes the company's management appear less efficient at managing its assets, and the increase in capital structure leverage makes the company appear more reliant on debt or more levered and therefore riskier. Thus, the use of capital lease accounting, which lowers ROA and raises capital structure leverage, makes the company appear to outsiders as a less attractive investment, less efficient management with more debt. Operating lease accounting, on the other hand, does not affect either ratio because it does not affect the balance sheet at all. No wonder that companies prefer operating lease accounting over capital lease accounting. And often companies like Home Depot structure the terms of their leases so that they do not meet the criteria requiring capital lease accounting: bargain purchase option, lease terms less than 75% of the life, and present value greater than 90% of the fair market value. So now you can see why operating leases are so much more common for Home Depot than for capital leases. Accounting standard setters have long been troubled by this practice. So very recently, a new standard in the area of lease accounting has been passed. It is effective January 1, 2019. And it is a product of a joint effort between the Financial Accounting Standards Board, FASB, and the International Accounting Standards Board, IASB, the body responsible for IFRS. It states that all leases over 12 months long must be accounted for as capital leases, while leases less than 12 months in length are allowed operating lease treatment. It is expected that this change will have a significant impact, reducing ROA and boosting leverage ratios on the financial statements of companies like Home Depot that rely heavily on leasing real estate. Airlines, shipbuilders, and many other manufacturers will also be affected. To get a sense of how this new reporting requirement will influence companies like Home Depot and Lowe's, let's return to Home Depot's footnote 5 and focus on the capital lease cash payment column. As we showed earlier, the total future cash payments associated with the capital leases is $1.489 billion. To come up with a liability on the balance sheet, Home Depot discounted that future dollar amount using present value techniques by $726 million, leading to the net present value of the capital lease obligation, which was disclosed on Home Depot's balance sheet, $763 million. This dollar amount is 51% of the $1.489 billion total future cash payment amount. That is, the balance sheet amount is 51% of the total expected future payments. If we assume that Home Depot was forced or chose to treat its operating leases as capital leases, which it will have to do for many of its operating leases in 2019, we can estimate the size of the additional asset and liability on Home Depot's balance sheet by multiplying the 51% times the $7.423 billion of expected future operating lease payments, leading to an additional asset and liability of $3.785 billion. What if Home Depot and Lowe's use capital lease accounting for all their leases? Here's the same calculation we just discussed for both Home Depot's and Lowe's 2016 balance sheet, taken from Home Depot's footnote 5, which we just analyzed, and from Lowe's footnote 12, which contain the same kind of disclosures. You can see that Home Depot capitalizes 16.7% of its leases, while Lowe's capitalizes a bit more, 18.4% of its leases. As we showed earlier, Home Depot arrived at its balance sheet capital lease liability by discounting its future expected capital lease cash payments by 51%, leading to a $763 million liability. Lowe's discounted its future expected capital lease cash payments by 53% to create a $400 million capital lease liability. If Home Depot capitalized its operating leases, as we also showed earlier, it would add an additional asset and liability to its balance sheet of approximately $3.785 billion, 51% times the expected future operating lease payments. Lowe's would add an asset and liability of $2.859 billion, 53% times its expected future operating lease cash payments. Capitalizing their operating leases would decrease both of their return on asset ratios, ROA, and increase both of their capital structure leverage ratios by amounts ranging between 7.4% and 12.4%. This is roughly the impact the new leasing standard will have on these two important financial ratios for these two companies, an impact that will be felt by a variety of major worldwide companies.